I've been working on this piece about Hamlet and climate change, and
Oh, really?
really going into it, really going into it in a lot of depth. And I keep finding all these similarities. It's quite extraordinary when you really
When you
dig
think
deep
about
into
it.
it. So
Oh, fantastic.
yeah,
History
so
repeating itself.
yeah,
I think
yeah,
I bet
totally.
I bet if you looked into the Mayans, you'd also find similar parallels.
Maybe that's my next project. I'm off to Mexico
Next
next
project.
week. So
Oh, really?
yeah, yeah, I'm
Oh,
going to
good,
visit
good.
a mangrove project in Veracruz. So
Oh, cool.
yeah.
Cool. Mexico's epic as well.
Oh
So, oh,
God,
fantastic.
I used to live there many years ago, so it's one of my favorite places.
Oh, wow. Did not know that. There you
Yeah,
go.
yeah.
With what took you to Mexico?
Well, but after I graduated, I didn't know what I wanted to do, so somebody said, "Why don't you go teach English in Mexico?" So that's what I did, and but that was a very different world in those days. That was 1988,
Oh,
so
wow.
there was no concerns about, oh, I have to worry about my career and my CV. Just okay, I'll do whatever, and then I'll come back and we'll see what happens. And
You just figure it out. The
yeah,
non-linear path to carbon markets.
exactly.
All right, welcome back to This Week in Carbon. I'm your host, Eddie Smith, alongside Renee Velasquez. And today we're thrilled to have on Mark Lewis. Mark, thanks for joining us. Really looking forward to today's discussion. And before we dive into this week's topics, I would love to introduce you to the audience
Mhm.
and maybe ask if you could share a bit about your background and your career path and maybe what you've been up to in the recent months.
Sure. Well, first of all, thanks very much, Eddie, and thanks very much, Renee, for the invitation to be on the show today. So it's a real pleasure to be on this leading carbon market podcast. I think you guys do great work, so it's fantastic to be with you again. Just briefly on my background, so I've been covering carbon markets since 2005. At that time, I was with Deutsche Bank. I broke into carbon markets because I was previously a utility analyst on the sell side doing equities. And when the ETS started in 2005, I did this deep piece of work on the impact of carbon pricing on the profitability of the European generation sector. And unbeknown to me at the time, but it was a wonderful boon in my career. Deutsche Bank was in the process of setting up a commodities team and a carbon trading team. So they asked me to move over from equity research into commodities research. I think, in fact, I was the first full-time dedicated sell-side analyst of carbon on the street. So that was amazing. We rode the wave of the first carbon market boom, carbon markets 1.0. That would be between 2005 and I would say 2012. A lot of the banks then pulled out. I left Deutsche, reinvented myself as an ESG analyst for a few years, and then when the European Commission came out with the idea for the Market Stability Reserve, I thought, okay, in 2017, this is really going to drive carbon pricing back to where it needs to be if we're to achieve the climate change targets. So I ended up moving on to the buy side of the industry, spent some time at BNP, and then most recently at Andurand Capital as the carbon research specialist there. And I just left. I left at the end of May. I wanted to take some time out and think about what comes next. And what I do know is I want it to be 100% carbon focused because I think the outlook for both compliance markets and what I call quasi-compliance markets, voluntary credits that have corresponding adjustments, so-called Article 6 credits, is extremely exciting over the next 5 years. And I'm sure we'll be getting into that in the course of this conversation. So that's how I came to it. It's where I am now, and looking forward to explaining how I think this all shakes out over the next 5 years with you guys.
Yeah. Well, thank you so much for the brief, explanation. You've had an amazing career in the space, and congrats on exiting Onderon recently.
Yeah, thank you.
So the first topic will be on EUAs and the outlook for EUAs. And I read a couple of different articles with differing opinions. right? So currently, EUA is trading around 70 to 75 euros a ton, and analysts are widely anticipating rising prices through 2025 and beyond. So there's a
Yeah.
bullish optimism underpinned by tightening supply and sustained demand growth, driven by recent EU climate policy reforms. And
Yeah.
you have Macquarie Bank, their latest outlook sees average EUA prices of 75 euros in 2025 and 95 euros by 2026. So a notable upward revision. But
Yeah. Yeah.
I also read that a lot of investors have been increasing their bearish bets on EU carbon allowances last week amid the looming threat by US President Trump to impose import duties on the economic bloc from August. So I saw that money managers were increasing the number of short positions during the weekend of July by the end of, equivalent of 2.2 million allowances. So their largest weekly increase since early April. So given this, landscape, I would love to ask and hear your thoughts on the key drivers behind the bullish outlook for EU carbon allowances, and maybe some of the reasons that folks have some bearish sentiment.
Sure. Well, I think the main bullish argument is very simple to articulate, right? I mean, there's two things. I always tell anybody who's new to the carbon market, to the European cap and trade market, the EU ETS one, as we're now calling it, and we'll get onto ETS two later. But is it has two distinguishing features from any other commodity market, right? Number one, the supply of the commodity in question is fixed and declining, and it's on a visible trajectory. We know what happens to the supply over time. There's no other commodity market where that's the case. You think about the oil market, I don't know what the supply of oil is going to be next week, never mind next year or in 10 years. Here you have almost, or certainly as close to perfect visibility as you're ever going to get in a commodity market in terms of the supply. So that's the first distinguishing feature. But the second one is the one I think that really makes for the long-term structural bull argument, and that is this. There are no natural sellers in this market, right? You think of any normal commodity market, somebody is producing it and somebody is buying it. There's a natural seller and there's a natural buyer. Here, there is no natural producer, as it were. What you have is a regulator who auctions allowances or makes them freely available, albeit in declining amounts going forward, because we're moving away from free allocation to industry towards full auctioning by 2034. But the key point here is if you want to stay in business as a power company or a steel company or a cement company, any of the industries that are covered by the scheme, you have to buy these allowances. So there are only natural buyers, no natural sellers. So you put those two dimensions of the equation together. On the one hand, a declining supply, now we know it's declining to zero by 2040, and the fact that there are no natural sellers, then what you have here is a market set for long-term bullish momentum, right? That's what that tells you. Now, timing is everything in markets, right? Einstein said that physics is the search for truth in space and time, and John Maynard Keynes said that speculation is the search for truth in price and time. Okay, so timing is everything, and undoubtedly, per your question on the intro there, Eddie, there will be moments where prices can fall, fluctuate, decline, and clearly President Trump's continuing dance around tariff levels, not only with Europe, but with the rest of the world, because there's the impact on the rest of the world to be considered as well. It's a secondary order effect on the European economy. Germany, don't forget, is the world's largest industrial exporter, so particularly sensitive to global export trends. Undoubtedly, this is a concern, but we've seen before that the concern around the tariffs has perhaps been a little bit overdone, and there is normally some kind of deal done. So I think, notwithstanding the fact that prices can suffer short-term volatility and short-term fallbacks, I think the setup over the next 18 months to 2 years, if that's your kind of investment horizon, is very bullish. in the sense that we are entering a period now on the numbers that I model in my model, where we're into 5 years of consecutive annual deficits. And in particular, for 2026 and 2027, you're looking at triple-digit deficits, which means that the demand will outweigh supply significantly. That will reduce the level of allowances in the market, the so-called TNAC, the total number of allowances in circulation. And in any market where the inventory is declining, because that's what the TNAC is, it's the inventory of carbon allowances, prices go up. So one has to be aware of the threat of recession. We have to keep following the news regarding tariffs and so on. But the underlying signal for all the short-term noise about tariffs and so on is that this market is going to get a lot tighter between now and 2030. That's the first thing. And I would make one other point in terms of being structurally bullish on this market over the next 3, 4, 5 years. Industry, that we have to take into account behavioral psychology. And what we have in this market is two kinds of players, really. You have the utility companies or the generation companies who, ever since 2008, have had to pay for all of their allowances, right? So they've been auctioned since 2008. What that means is they've typically hedged their buying requirement on a rolling 3-year basis, and they have been the main driver of pricing in this market, which is why the fuel switch between coal and gas has been the proxy, the kind of shorthand way in which traders have looked at where the price, quote unquote, should be at any given moment. You look at the carbon price there, it's 70 euros a ton, and then you look at the implied fuel switch and you say maybe that's 50 or maybe that's 100, and therefore you say, well, the price should be higher or lower as a function of that. We're now moving into a very different market where it will no longer be the utilities that are driving price, but industry. And that's for two reasons. One, the power sector is decarbonizing very quickly anyway. You know, the renewables revolution means that there is no longer much of a need for fuel switching per se in the power sector, and there's not much of it to be done. So much of the coal has already been taken off the grid. So you look at a market like the UK, I know it's a separate market, but it's a proxy for the European market more broadly, because this is where the whole of Europe is going. There's no more coal in that market. You only have gas. You can't switch between coal and gas. That's the way Europe is going. There's less and less coal on the grid. So fuel switching, much less important. And what that means is it's industry that will drive pricing, and industry will drive pricing for two reasons. One, because they're losing their free allowances progressively over the next 5 years. So they will have to be in the market more actively. That's what I mean by behavioral psychology. Their entire behavior with regard to this market is going to change. And of course it's going to change, because if you get your allowances free every year and it matches the number you need, or until quite recently has been in excess of what you need, you don't need to worry about hedging. But now you have a situation where they know two things. The cap is declining, so the overall pie is shrinking, and the share of that pie that they receive for free is also shrinking. And that falls to zero by 2034. And then the cap overall falls to zero by 2040. So at some point, I expect over the next 18 to 24 months, 2 or 3, 4, 5 of these big industrial companies that have large amounts of carbon to hedge will step into the market and start doing that. And once that happens, the pricing dynamic in this market changes very significantly, I think.
Yeah, certainly. And
Thanks, Mark.
you know, do you think that some of the key changes under the Fit for 55 package, the 2023 revision, like, sectors like maritime shipping and intra-EU aviation, increasing demand plays a significant role in this kind of changing landscape? Also, the Repower EU program. Maybe you want to touch on the policy.
Yeah, sure.
Kind of evolving that's driving this market.
Of course. Well, I think to take those questions one by one, I mean, first of all, the inclusion of maritime is 50% of maritime emissions, as we know, from i.e. 50% of all emissions from ships entering and leaving the European Union, which is different from how they've done aviation, and we can maybe come back to that in a moment. But in terms of shipping, it helps at the margin for sure, because the cap for aviation, for maritime emissions is also declining with the overall cap. And it started actually at a tighter level than it did for industry many years ago, obviously, because the European Commission has learned a lot in the interim. So it helps at the margin, but I don't think it's in and of itself, the maritime sector is big enough to make it is so game changing. But at a point in the cycle of this market, where the cap now is really declining very aggressively every year, if you tighten it incrementally by adding new sectors that are also short, clearly at the margin that makes the outlook even more bullish. So I think yes is the answer there in terms of the addition of maritime. Aviation is a trickier one because, in theory, what the directive says is that, or in law, what the directive says is that all flights entering and leaving the European Union, in addition to flights within the European Union, should be covered by the scheme. Now, what happened was, at the risk of telling your audience something they're already very familiar with, is that in 2012, because of political pressure from other countries like the United States, India, Russia, China, and so forth, the European Union agreed to the so-called stop the clock measure, where they said, okay, we will suspend the idea that all flights entering and leaving the European Union have to be covered, as long as the International Civil Aviation Organization, ICAO, the UN body that governs aviation, agrees to some kind of voluntary effort that is meaningful and substantial to reduce emissions, so that they're not being given a free pass, as it were. Now, this is why we have Corsia, and of course that could become a very interesting dimension to the broader global carbon market in the next few years. I suspect it will do, in fact. But for the time being, we now await the key decision from the European Union, which I guess we'll get next year or the year after, as to whether or not it is satisfied that Corsia is meaningful and substantial, such that they are happy for it to continue being the way in which global or international aviation that comes in and out of the European Union meets its carbon obligations. We'll have to wait and see how that plays out. I don't think the politics have changed. I think it is going to be difficult for Europe to unstop the clock, as it were, or start the clock running again, because there will be political pressure undoubtedly from all these other major jurisdictions. So we'll wait and see on that. What I would say is, if Europe said, sorry, we don't think Corsia is meaningful enough, and we're going to start the clock running again, and every flight coming in and leaving the
That'd be a
European
huge shift.
countries, then that would have a major impact on the tightness of the market. That would be very bullish indeed. So let's wait and see. That's not my base case, because I think the politics of that are very complicated. I think everything that was in the Fit for 55 package is supporting this idea of the upward trend in prices, because and that's not surprising. I mean, this is the EU ETS 1 is the cornerstone of the European Union's climate change policy. So to the extent that they are banking on carbon prices being the way in which European industry decarbonizes and helps Europe meet its ultimate net zero challenge by 2050, prices do need to go higher. So that's kind of what the market is there to do. Well, they need to go to the level that the price discovery needs to reach a level where industry is incentivized to reduce emissions. I don't think 70 euros a ton is where that happens. The question is it 100, 120, 150, 200? That's what we're going to find out over the next 5 years.
Yeah, certainly. Renee, did you have any thoughts that you wanted to jump in on? I see.
Yeah, I'm just nodding very very aggressively here in the background. I'm really enjoying this. Mark, again, thanks for coming back. I said before we started rolling and recording how great the episode was on the Carbon Exposure Project, the other podcast, and how many requests I've had for you to come back. So really grateful that you're here and providing once again a masterclass on everything from EU ETS all the way through to Corsia. Look, I just have some observations. I think you gave us and you walked us through this very complex landscape, and you did so really eloquently. So I think the audience will really get essentially what everything you're saying here around this bullish case that you've built. In terms of reflection, and obviously you mentioned it from the outset. You were the first analyst, carbon specific analyst or carbon focused analyst in the city of London, back in the day, and to me, the EU ETS has evolved from a clunky policy tool, essentially, to one of the most sophisticated commodity markets. And you intimated that, right? When you said that now there's a visibility around fundamentals, around the direction of travel because of the tightening of these various different systems. So Market Stability Reserve, the MSR in particular, you talked about Fit for 55 and the direction right there. And essentially, now we're seeing this true price discovery, and you mentioned that earlier, right? Driven by these fundamentals, and it's not just Brussels edicts, right? That are driving that, right? The structural tightening piece between the MSR, the cap reduction, you've got sectoral expansion into maritime, and you kind of the sword of Damocles hanging over aviation. But effectively we're witnessing this most aggressive sort of supply side reform since the system began. Is kind of how I see it, and I liken it to kind of like quantitative easing, but in reverse. It's essentially every year there's less and less supply, as you said, or less oxygen in the system, and so that has an inflationary effect with regards to prices. And as you correctly just said in your last kind of point, is the price band has been fairly. I mean, it's been in the last couple of years. I was just looking at the ICE futures. Somewhere between 80 euros a ton, per EUA in January of 24. And a low of 55, what is it, in that time frame? And it's been somewhere between this 80, 85,
50 to 85
and 60 sort of range.
Yeah.
And it's been kind of up and down, but now it seems that this is kind of a really interesting inflection point as a result of this run towards 2030. And I think that when we certainly speak to hedge funds, they're treating EUAs essentially as a macro trade. Right. Yes. They look at it, as you said, a proxy for energy policy and industrial demand. And now you've got this coupling around this geopolitical volatility. So carbon's no longer niche. That's the take-home message that I want people to take away. Absolutely. It's no longer this obscure little corner of commodity markets. It's a real commodity market that is ubiquitous, and it touches on every single industry. So they're just some observations based on what you've. I mean,
it's a great point, Rene, because I think the other thing that people will have to start bearing in mind much more going forward is not just in the commodity space, but in the equity space. What's the impact of higher carbon prices for fund managers who hold, European equities in industrial sectors? There's going to be a lot of analysis needed. I mean, one thing that strikes me is
sort of stranded asset sort of test.
Well, yeah, and just the fact that the sell side, and I can say this as an ex-sell side guy, I was on the sell side for 20 years. I would never say that sell side analysts are lazy, because it's the hardest job I ever had, right? You have to be on top of everything and so on. But what does tend to happen on the sell side, particularly on the equity sell side, is that the analysts focus on the areas that the companies themselves focus on. And this is why you've not really seen, even now when this market has been up and running for 20 years, analysts of the steel sector or the cement sector or oil and gas sector focusing on refineries, chemicals, detailed research reports from these guys saying what's the impact of higher carbon prices on our sector over the next few years as we lose free allowances and so on. So over the next 3 or 4 years, there's a huge amount of learning to be done by the sell side analysts of these sectors, because once the behavioral psychology of the companies they cover changes, their coverage will have to change. And ditto for the fund managers who manage equities in these sectors. So figuring out who are the winners and losers at an individual company level across these different sectors as carbon prices start to rise, who's hedging well, who's not hedging well, etc. That's going to be a major source of alpha, I think, for fund managers, whether it's in the long only space or in the hedge fund space. So it's kind of the underappreciated aspect of this carbon market. It's of course it's an asset in and of itself, but it's an asset that will affect increasingly the profitability of industrial Europe over the next until the market ends now in 2040.
Yeah, and I want to touch
really
on
interesting.
Yeah, I think
can I double click on that one? I mean, that to me is really interesting because essentially it's, you've got carbon, as you said, it's not just, or the sell side coverage is essentially finally waking up, is what you're saying, right? It's not just as carbon as a trade. So the alpha is not just in the EUAs themselves, but it's in anticipating which sectors are the most exposed and essentially who's positioned to the arbitrage, like to that transition, right? Or to arbitrage that transition. More
absolutely, yeah.
And so I'm just wondering, like, what's that headline risk, right? For those analysts, you mentioned cement, steel, and chemicals. Like the EUA curve is essentially the new cost of capital, effectively, right? For them, because essentially that hasn't been factored in according to what you said before.
Exactly.
30 euros, an EUA wasn't really a pain point. But once we hit triple digits again, it's going to be material, right? Like it could actually be material to the balance sheet and to CapEx, right? So where is CapEx going to kind of hedge for that risk? Because the direction of travel is clear, like decarbonize or don't exist, right? And then you got CBAM on top of it, which reduces the leakage piece. So the EU is not going away in terms of population, in terms of demand. So it's a very, very significant policy direction, and it's kind of like baked in.
Well, the way you said that there is very true. Rene, the decarbonize or don't exist. I prefer to call it comply or die.
Comply or die.
And that's what industry is going to have to wake up to. It's comply or die time, right? And that means they have to be much more active hedging. Again, the risk of sounding like a broken record, it's all about behavioral psychology now, and that will drive. So we've got this backdrop of very supportive fundamentals in terms of supply. What changes on demand is a change in behavior. It's not that there's going to be an increased demand per se for allowances. It's that the way they behave in seeking those allowances is going to change.
It's kind of funny because in 2020, sorry, I didn't cannibalize this whole thing. I know you've got other topics to get to, but I'm just going to nerd out here with Mark as a person that I admire immensely and I just love talking to. So in 2020, a lot of folks came in as the voluntary market was kind of getting its feet sort of set, and we started to see the first futures contracts, and started seeing increasing liquidity, et cetera, and a lot of folks kind of were just overly bullish, and they said, carbon is the new oil. And I remember that quote at that time thinking, guys, no, please don't jinx us. But essentially, what I liken it now to what you're saying is essentially, the smartest analysts are treating carbon, in particular EUAs, as a leading indicator, much in the way that if you essentially if you read oil, like, carbon's kind of like oil in that it's not just a trade, but it's a macro variable that moves those industrial margins, those share prices. You talked about equities and essentially capital flows. So if you're still modeling the EU ETS exposure as a footnote in an industrials report, essentially you're missing the plot. Carbon's become effectively the fulcrum, and the smartest analysts are treating it like that leading indicator. And I think that's a really interesting kind of position for it to break out from this kind of tight band, as you said, between 55 and 80, and essentially just bust out of that, and then fundamentals kind of drive that direction. And as you said, it's just going to be harder and harder to get ready supply on a forward basis and to lock that up for the big industrials. And that's what will move the market, where the bids start chasing the market up and up and up and up. And then the smart hedge funds that could just load up on this stuff.
Well, that is exactly right. That was the point I was going to make. And if we're probably not going to have to wait for the first industrial to do that, because hedge funds will anticipate that. Right. Hence the
Yeah.
comment about, you know, speculation.
So it's a naturally long market. So that's an interesting kind of view around supporting your bullish like sentiment. So cool.
Exactly.
Thanks.
Exactly. Yeah.
Yeah, and I think like touching on more of a macro perspective, obviously high carbon price is intended to incentivize deep emission cuts in EU power and industry and maritime, and that impacts, like you said, all different angles of the economy. And I would say there has been quite some pessimism about Europe recently due to regulatory constraints and overall lower growth rates compared to other nations. We're seeing GDP in large European nations fall behind, and a lot of industry executives are increasingly voicing their concerns about further climate policy and further regulatory constraints. And I would like to ask you, Mark, since you've obviously seen this market through multiple cycles, and from your experience, how significant is the correlation between, high carbon prices and lower economic growth and output? And what is your kind of forward-looking perspective on this topic? Because there is a lot of voiced concerns from European execs on further climate policy. Yeah, I would love to hear your thoughts.
Right. Yeah. So this is obviously a very controversial and difficult topic. Technically, lots of layers to it. The big picture way I would answer this is to say, look what happened in the summer of 2022 when we had those record power and gas prices. European gas 5 years ago, before the troubles with Russian gas supply into Europe, European gas was trading at 15 euros a megawatt hour all the way down the curve, right? That was, let's say, the old normal was 15 euros a megawatt hour for TTF.
Yeah.
And German power had never once traded above 100 euros a megawatt hour, German baseload power. And in the summer of 2022, we saw TTF reach 350 euros a megawatt hour. And German baseload power, very briefly, but it did trade there, 1,000 euros per megawatt hour. But European carbon never went above 100. Well, it got to 100. It didn't go higher than 100, or not much higher. I think the all-time high is 101 euros 25 cents, right? What does that tell you? It kind of tells you that Europe has been, and of course, prices have come down, but we're still back at what are historically high prices, very high prices for European power and gas, right? And European industry is suffering under that. So I think the first thing to say is that for all of these energy intensive industries, it's the price of power and especially the price of gas, which in any case determines the price of power, that is more significant than the price of carbon. That's the first thing I would say. And it was very interesting to me that, it's kind of the way human psychology works. If we'd had European carbon at 100 euros a ton, with power at kind of 50 and TTF at 30, I think there would have been huge outcries over carbon prices, right? But because power went so much higher and because gas went so much higher, and if you were doing the fuel switch, I worked out at the peak in summer 22, I remember doing this calculation at the time, if we traded on the fuel switch in the carbon market, the price of carbon would not have been 100 euros a ton. It would have been 500 euros a ton, because that would have been the price needed to switch from coal to gas, because gas was so expensive at the time. And yet carbon just stuck around that 100 level while the other commodities were having their crazy moment. And that kind of tells you actually.
So no elasticity really with regards to that volatility. That's interesting.
Yeah, exactly. So I think the thing about carbon on its own having such a major impact on, the macro level for the European economy and for European GDP, it's possible to over exaggerate it. I'm not going to underplay it, and I'll come back to this point in a moment, but I'm saying power and gas are actually more important, right, in the grand scheme of things. Now, That being said, we are moving, as I said earlier, and you've heard me make this bullish case now for EUAs. I think that if I'm right and we see prices of maybe 150 euros a ton for EUAs within 2 years, which I think is perfectly possible, that is going to cause definitely problems for some of the very heavily energy intensive industries. We already know that the aluminium industry suffers with high carbon prices. Anything that uses a lot of electricity will suffer. But this is exactly why we've brought in CBAM, right? So the point about CBAM is that CBAM is there to try and mitigate, try and offset, in fact, neutralize the impact on European industrial competitiveness of higher carbon prices, because it will require that foreign companies pay the same carbon price at the border, effectively, even though it's a pass through to the importer. But nonetheless, what's happening is effectively the carbon price at the border is being adjusted upwards. So foreign exporters into Europe are paying the same carbon price effectively. Now, the problem with that is that it only solves one side of the equation, because European exporters who are exporting to other jurisdictions outside of Europe, they're not getting any help. So they're losing free allowances and they're exporting into jurisdictions that have much lower, if any at all, carbon prices. So I think that is where it will become tricky, and there will be, for every industry and for every company within each industry, different price levels of carbon that cause them pain. But ultimately, this market is about price discovery and getting them to find new ways to produce things more cost effectively. So look, summarizing all of that, I said it was a technical issue. There's lots of layers to it. It's difficult to run through it in a very short period of time, and we've got other stuff to get through. But to summarize it, I would say Europe should be very alive to the risk on industrial competitiveness of higher carbon prices as we move towards 2030 and beyond. Particularly for European exporters in these sectors. And that's why, in my view, one of the tricks they have missed, perhaps the biggest trick they have missed, is allowing, and I'm sure they'll have to revisit this, by the way, I just don't think this can stand. But 2 weeks ago, when they came out with the proposal, the Commission came out with the proposal for a 90% reduction in emissions by 2040 for the EU overall, right? For the EU overall. They said we will only allow 3% of the entire cap to be in terms of volume. That's the cap on the amount of offsets we will allow into Europe, not into the EU ETS. In fact, what they've said is we will not allow at this stage Article 6 credits into the EU ETS beyond 2030, and even for the non-ETS, or at least non-ETS 1, so you're looking at ETS 2 and then the agricultural sectors, I guess, you're looking at 150 million tons in total over 5 years from 2036 to 2040. That's 30 million tons a year. That's 1 million tons per member state per year for 5 years. It's absolutely nothing. It's not even peanuts. And so I think they're going to have to revisit that, because I just think that European industrial competitiveness, particularly if gas prices have not come down more by then, and one would hope that with all the LNG that is meant to be coming online over the next 2-3 years, European gas prices will fall back. But nonetheless, there is a risk clearly to European industrial competitiveness here. And I think the way you square the circle is by allowing Article 6 credits with corresponding adjustments into the market beyond 2030.
But in a gradual manner, right?
Yeah, right.
It's like a release valve, essentially.
Yeah, totally. Yeah. I mean, if you think about it, just some easy maths on this.
Yeah.
Between 2008 and 2020, the EU allowed 1.6 billion tons worth of Kyoto credits, so CERs and ERUs, into the market. That 1.6 billion represented 7% of the total cap, the total EU ETS cap over that period. So if you did a similar thing here, you'd be looking, I'm doing this very much off the top of my head here. So let's say the cap between 2031 and 2040 is 4 billion. It's going to average about 400 million a year over that period. 4 billion times 0.07. Yeah, you'd be looking at about a 300 million Article 6 credits with corresponding adjustments. At a minimum, I would say. And so I just think the European Commission at the moment, frankly, has got its head in the clouds. I mean, it's just not thinking this through properly yet. And let's put it this way: if carbon prices were already trading at 120, I think there would have been a much greater readiness 2 weeks ago when they published that document to allow for Article 6 credits to come into the ETS beyond 2030.
Certainly, yeah. And there's a lot to unpack there. So, maybe I would love to ask, which segue would you want to take this in? We can discuss the EU, UK ETS linkage. We can discuss the outlook for EU ETS 2, where we can go.
Can we click on EU ETS 2? Because Mark, you've mentioned it in your intros a couple of times, where you said the old EU ETS is now ETS 1, and now we've got ETS 2. That's another kind of quirky duck.
Yeah,
right.
It is. Love to.
So I'd love to hear more what you think about it, because it's kind of like, it's just an odd one. It's effectively, EU ETS wasn't just tightening, like you said, right? It was this kind of structural, kind of industrial piece, but effectively, so like, ETS 1 was the cleanup proof for the smokestacks, but ETS 2 is essentially the front line of this climate policy, but in everyday life.
That's right.
And so that's the bit that I think will make it, very politically a hot button.
Oh, very
topic,
much so.
Because it's carbon pricing in people's living rooms and on their fuel receipts. And we've seen situations in particular with regards to fuel pricing, et cetera, where it's toppled governments in certain parts of the world, or it's created a lot of social unease and unrest. I remember the Maillot Jaune in France,
absolutely
kicked off by this. So it just give us a little bit of an overview about ETS 2. Sure. And where you see it kind of walking this fine line between, let's acknowledge its ambition, but exposing a little bit of its vulnerability, if we can.
Yeah, totally. Well, so just what is it and when does it start and so forth? So from 2027, 1st of January 2027, the heating and transportation sectors will be covered under a separate market called ETS 2. That doesn't have a formal link with ETS 1. That may or may not transpire in the future, but for the foreseeable future, there's no intended link between the two. Now, the curiosity about this market, and this is to your point, Renee, is that this has a much more direct impact on retail, or to put it in even simpler political terms, on voters, right? I mean, it will be your everyday mum and dad who are filling up their car with petrol, or putting on the boiler in the winter because they need the central heating cranked up because it's a cold winter. There will be a carbon price on those activities from the 1st of January 2027, and there will be no free allowance.
You're not just pricing emissions here. You're essentially pricing behavior.
Yeah, exactly.
Yeah, and when you do that, you need political armor, because it's not just economic theory anymore. It's affecting people's personal balance sheets.
Totally.
I mean,
it's visible. This is visible, whereas your average consumer is not seeing, certainly hasn't seen at all, until now, except in the realm of electricity prices, where the carbon price has been passed on, but you haven't really seen it in steel prices, or because there've been free allowances. And as those free allowances are phased out over, as we discussed earlier, that those prices will start coming through more as well. But here, from day one, there will be a pass-through into petrol prices, gas prices, all the fuels we need for transportation and heating. Now, there's a couple of things to say about this. That being said, it will not be levied at the individual consumer level. It will be levied at the wholesale level. In other words, it's the suppliers of fuels who will have to pay who are responsible for buying the carbon allowances that go with the emissions, what will be their scope 3 emissions. But obviously they will pass that through to the end consumer. So the end consumer will see it. They won't have, and they'll pay it. They won't have the administrative burden of having to purchase the actual carbon credits, but
Sure,
they're going to have to, but they're going to see it. So that's just on the mechanics of how it works. Now, I think to your point, Rene, this is politically highly combustible. We saw with the Gilets jaunes, as you mentioned, in France 5 years ago, a tremendous backlash against higher petrol prices as it was at that time. And I do worry that we are setting ourselves up for a similar political backlash, particularly in a climate today where populism has only grown in frankly, even in the governments that are not nominally populist, there are more populist measures being taken. And I think, if carbon prices in ETS2 were to go above 100, it would be extremely tricky. Now, let's talk about some of the safety mechanisms here that are in place. Number one, they're going to auction 30% more supply in the first year so that there is a soft start, so that you don't notice a huge difference from day one. Secondly, there is a specific mandate in the legislation to protect the most fuel, citizens who are already in fuel poverty will not pay the price, or they will pay it and then they will be reimbursed. But of course, that's administratively burdensome, and there is a cash flow impact.
Fund.
Social climate fund, exactly. But there's always winners and losers there at the margin, and it's tricky to demarcate, and it takes time to reimburse and so on. So you will get the flames of indignation first, before the fire brigade of reimbursement comes along to put out the fire. And so it's a risk. But the other thing is there is a price cap.
I like that.
Yeah.
I like that analogy. It's a really good one. Essentially, you're saying that there's no energy transition without the demand side reform. And effectively, ETS2 is that reform, and it's bold, essential, and politically flammable to
exactly.
Your
Totally right. Yeah. Totally right. But there's a price cap initially of
what's that at 45 euros?
It's 45 in real terms adjusted. So inflation adjusted against 2020. So I don't know, 45. If you assume 2% inflation, it was higher.
Inflation rate in Europe?
Let's assume 3% inflation over the last 5 years. Even that might be too low. It gets you to sort of 55, something like that. I think, to be honest, 55 is probably
just 45 euro to 55 euros a ton, and said additional allowances will be automatically released from a reserve to cool down the price
so they're starting.
So it's got the MSR functionality as well.
Yeah, they're starting with a market stability reserve where they will be able to inject. So I think they are desperate to avoid a rerun of the Gilets jaunes saga that we had in France.
Yeah, well, it's to mitigate the volatility in that market, because if it runs on its own fundamentals, that market could be just like you said, it's a naturally long market on the allowances, and effectively it's a short squeeze. And so the utilities and the fuel companies, etc., they'll pass on those costs to the eventual consumers, and then that's the politically flammable kind of component there. So it could be really one of the most transformative carbon pricing tools we've seen, or it could just become, like you said, Europe's next political punching bag, effectively.
Oh, completely.
So kind of keeping it within a tight range and kind of let's call it training wheels would I think be pragmatic.
Right. And what's interesting is that ICE have already developed a contract on ETS2, and it hardly any volume at all, but it has traded, and it's traded, to my surprise, at levels close to ETS1. I think the strip starts at 2028 though on ICE. I don't think they have a 2027 contract. I may be wrong, but in any case, that's not really a meaningful price signal yet because the volumes have been so low that you can't really read anything into it. The other dimension to this in terms of political flammability is if hedge funds and speculators were to start playing aggressively in that market and forcing prices up, I mean, there would be an absolute hailstorm of political heat in Brussels. So
yeah, it's very interesting.
The contract launched July 8th. So
yeah.
I haven't looked at it on the screen where the price is at, but that's an interesting one.
Yeah, it seems that a lot of folks foresee delays or adjustments to the ETS2 launch. There were signs of delay. Plans were due by June 2025 for the member states drawing up social climate plans, but 26 out of 27 EU countries missed that deadline. So people think that this highlights there's ongoing coordination issues and risk that
potential fragmentation as well.
The consumer compensation mechanism.
I'm sure Poland's probably not too
may not be fully ready. Yeah.
Right.
I would love. Right. Is it any take on delays or adjustments to the launch?
I think they will try their best to avoid that because I think the problem here is that the legislation allows for a 1-year delay. I'm not sure what happens if they delay it for a year and then energy prices generally go even higher than they were in the year that they delayed it from, and then all of a sudden you have to start worrying about delaying it again. So I think you don't want to set that precedent as a policymaker because it undermines the credibility of your new market from day one. That being said, if they're forced to do it, I think they will have to politically, and there will be certainly some member states who would want to do that almost regardless of what's happening with energy markets more generally. I think again, as one has to be conscious of the shifting political sands in Europe and the drift towards what we might call the populist right, who are not fans of climate change policy, in many cases don't believe in climate change, or at least claim not to believe in it. You're seeing, for example, a breakdown in the UK of the cross-party consensus between Labour and Conservative that we've had for the last 20 years, ever since the EU ETS was up and running. That has now broken down. Clearly, the Conservative Party think that there is more political mileage to be had in backtracking or backpedaling on the net zero target. And Nigel Farage, the Reform Party leader, has come out and said that, quote unquote, net zero is the next Brexit. I mean, he thinks that there's so much political mileage for him in this that he can run for the next election, run to be Prime Minister of the UK on a ticket saying, we will get rid of the net zero targets. We don't think climate change is a problem, so which coming at a time when the UK is about to experience its 4th official heat wave of the summer next week is paradoxical timing. But the cognitive dissonance on climate change is only growing, because the climate is getting much worse, much more quickly than anybody thought even 5 years ago, never mind 20 years ago when I first started looking at this. And but unfortunately, the political response to it is becoming more and more diluted.
Yeah.
It,
Yes.
it reminds me of the cognitive dissonance. I love that. Of that movie with Leonardo DiCaprio and Jennifer Lawrence, Don't Look Up.
Oh yeah,
Right?
exactly.
Yeah, with this imminent asteroid collision. And it's
Completely.
like, just don't look up. Everyone just kept looking down, and you can
Exactly
see it
right.
in the sky.
It's exactly right.
It's inevitable, but it's just like, no,
Yeah.
don't look up.
Yeah. Yeah.
But maybe this is a good transition, Eddie, to talk
Yeah.
about the kind of EU UK
Yeah. Certainly.
linkage in carbon markets. I mean, Mark, to kind of help set it up,
Yeah.
and for Eddie to kind of get you to give us the context here, but like essentially this market linkage between EU and UK is like carbon market diplomacy effectively, right? So if Brussels and London can pull this off, especially post-Brexit, we talked about Nigel Farage, it really sends a strong signal to the rest of the world. So, there'll be cheerleaders, us and I want to, sorry for that visual to our listeners, who will want that to be the case, right? But like you said, it's a difficult one given the kind of the populist kind of undertones that we're seeing in the political realm. Eddie, do you want to kind of cue us up around the linking piece?
Yeah,
Mark,
certainly.
I
mean, on the topic of Brexit, after Brexit, the UK launched its own carbon ETS, separate from EU's, and now the EU and the UK have agreed in principle to link their emissions trading systems, creating a unified carbon market across both jurisdictions in May 2025, at the first UK-EU since Brexit leaders kind of announced these plans for a closer cooperation on emissions through linking our respective ETSs. Now, it's not legally binding, but it shows strong intent on both sides to negotiate the technical linkage in the next couple of years. And, if achieved, this would be a significant reintegration of climate policy between the UK and the EU, with implications for carbon prices and market liquidity and regulated companies in both regions. There are some important conditions attached to the plan, such as, there would be a mutual exemption from CBAM on each other's goods, and that makes sense. And a government arrangement must be set up, arbitration-based dispute resolution. There's a lot of different things at play here, but setting up for you, Mark. What do you think this ETS linking entails, and what do you think are the main benefits of the linkage of the UK and EU carbon markets from both sides? Maybe from a liquidity perspective, cost efficiency, avoiding double carbon charges like spam. Would love to hear your perspective.
Sure. Well, the first thing to say is, of course, that until 5 years ago, the UK was part of the EU ETS. So linking them shouldn't be that technically complicated. I think they can do this. If the will is there, I think they can do this easily by 2027. Or certainly no later than 2028. Because I say that because I hear a lot of people saying, oh, well, it took Switzerland forever to link with. Yeah, Switzerland was never a member of the EU. And its carbon market was never literally part of the EU ETS. So that's the first thing to say. Second thing to say is that it makes total sense for both parties, but more sense for the UK than for the EU, because the EU remains the UK's largest trading partner despite Brexit. And with CBAM coming in Europe, there's an incentive for European industry, for UK industry, to avoid that charge, and this is how you do it, by linking your carbon markets. And then definitely for all UK participants, having effectively a deeper market, which is what linking provides. The UKAs would become fungible effectively with EUAs. It just gives you it gives you more confidence in the integrity of the market, that you won't get big price swings, or they'll be smaller than you would get in the UK in the UK market. So definitely makes sense from the UK side, and I think from the European side, it makes sense for the same reasons. It's less compelling because the EU market is much bigger than the UK market. There's a minor, again, similar to what we said about maritime emissions earlier, it increases the tightness of the market overall at the margin, because the UK target is slightly more ambitious than the European target. So you end up with extra demand on the system, on the EU system, by including UK operators. So I think in all senses it makes sense. It's economically efficient, and we're trying to reduce emissions globally and in Europe in the most efficient way. So the bigger the market, the easier it is to do that.
That makes sense.
And I think that there's an extra political benefit here to your point, Eddie, in your intro there, in that if the EU can show globally that any country that links its carbon market to the EU will be exempt from CBAM, and I think this is particularly significant going to Brazil for the COP in November. You can say, well, this is how we globally join up to fight climate change. So I think there's and on top of all the economic arguments, which are the main arguments for doing this, there is a compelling geopolitical dimension to it from a European perspective.
Yeah, I really like that, Mark. Thanks for that. Can I chime in, Eddie, just with some kind of views? And look, our firm, we're not trading UK or EUA futures, but just as a trader, I can't help myself always ask that question to myself, like, where's the trade? Some kind of thoughts around what you've said to help to unpack it. Yeah. And then kind of my kind of naive, let's say, view, like a non-expert view, let's put it this way, around the kind of where's the trade. And I'd love for your correction and or agreement in terms of thoughts. But effectively what you said is essentially, and correct me if I'm wrong here, right? But linking the ETSs is like connecting essentially two pools of capital. And it helps to deepen the liquidity, and it helps to sharpen essentially that price discovery, and it reduces the market friction. We talked about CBAM. Yeah. So that's that point there. And then in terms of the trading side, essentially, UKAs have been trading at a discount to EUAs, so just having a look on the ICE futures, and the last price is at 51.10. Yeah. And it's kind of been in this fairly tight band since the beginning of the year, since between 35, let's call it tight band between 40 and 50, right? Yeah. And that's it's at a discount to, let's call it 10 to 15 euros, around there, lower 10 than now, the EUAs. Around 10, let's say 10. Right, depending on policy cycles and energy demand and a bunch of other stuff at auction volumes. So essentially, when linking happens, the allowances, and correct me if I'm wrong here, but essentially the allowances become fungible across the systems, UKAs and EUAs. So essentially you see this direction of travel towards convergence. And so essentially UKAs will likely rise towards the EUA levels as demand increases from EU buyers, and effectively UK aligns its emissions cap more tightly with the EU ambition, and essentially it creates a directional arbitrage, right? Long UKAs now, short EUAs, maybe over the short period of term, or buy UKs out on the forward curve, and there's that arbitrage split. Maybe coming back to an Easter egg that Eddie kind of planted earlier, is maybe that supports the thesis that some of the hedge funds have that are shorting EUAs right now. Do you think that that's part of it?
Yeah, I think actually that's a great point. And I was saying when I was still at Andorand, I mean, there was a Bloomberg article written in October last year where I came out very bullish on UKAs, saying at the time the gap was 35 euros to between UKAs and EUAs. And I said, this is insane, even if you don't believe linking will ever happen, because the UK market intrinsically is tighter than the EU market, right? Because the UK climate target is more ambitious. That's the first point. So, but if you then add in the possibility of linking, which is now kind of coming to fruition, right? That was always a huge arbitrage opportunity. And I think, from the beginning of this year, when the political debate on this really got serious, and you had this FT article in January saying it's going to happen, you've seen that a discount narrowed from 35 to 10. And I think probably it's going to trade in a discount between 5 and 10 euros until everything is done. But I think 10 is probably still a little too high. I think €5 for any sort of, transactional things. But yeah, I think it makes sense for some hedge funds may have been shorting EUAs, buying UKAs on this arbitrage idea. And effectively what will happen in this kind of interim period when we know that linking is going to happen, but we don't know exactly when it will take effect, is that a trading range will be established. And I guess 5 to 10 is the range. So you're not playing for much at the moment, but every time it drops to 10, people will want to buy UKAs, sell EUAs, and every time it hits 5, do the reverse, buy EUAs, sell UKAs. I think that's going to be the trade for as long as we're in this holding pattern until the formal linking itself happens.
Do we have a date in terms of when that formal linking happens?
No, we don't have a date yet.
Kind of
I think that will be a function of all the kind of bureaucratic things that have to be figured out. But coming back to what we said earlier, I mean, UK politics and European politics would certainly favour an expeditious move on this, because if the link is already established, where let's assume worst case scenario, we have Nigel Farage coming in as UK PM in 2029, and he says, I'm going to tear it all up. That might sound great when you're running for election, but once it's all bedded down, you've got European and UK industry part of the system, and then you're changing the rules on UK industry again.
Corporates hate that.
You hate it. So I think I'm certainly not underplaying the risk of the populism that we're seeing across Europe, but
it could actually be, like you said, it could be fuel for them to run on that platform. But it's interesting, and it's a cheeky question, right? But essentially, ultimately, comes to this kind of thesis that if you believe in the convergence, the trade's clear, like you said, right? Long UKAs ahead of the linkage, and ultimately, once that date becomes apparent, it's kind of an interesting one as a trader, because it's not every day you get a event with a calendar on it, right? So that trade is kind of placed, and then it's like, cool, comes into effect.
Exactly right. Yeah.
Thanks, Eddie, for letting me indulge on.
That's great.
Nerdy trader talk.
Great discussion there, and I think shifting gears to our last segment on kind of what we touched on earlier with Article 6 and Corsia and the impact on voluntary markets. Like you said before, Mark, the European Commission announced its proposal for the European Union's 2040 climate targets, aiming for a 90% reduction in greenhouse gas, right? And we're seeing the carbon removals industry really calling on the EU to integrate more CDR credits into the ETS starting in 2030. Like, as you said, they have allowed for the international use of Article 6 credits to meet up to 3% of the EU's 1990 emissions.
Right.
And, we're seeing the global architecture of carbon markets evolving fast between Article 6 of the Paris Agreement and Corsia. And this is moving from, theory into real world implementation, right? And we have Article 6.2, the ITMOs, Article 6.4, the UN supervised PAC-M, and Corsia is now fully operational with 6 crediting programs approved. I think looking forward, do you see Article 6 carbon markets scaling up to potentially, dwarf the current voluntary carbon market, or will they more likely complement each other? And how can market participants best prepare to engage with Article 6 mechanisms, as well as Corsia? Because there is an argument people have about the relationship between the EU ETS and Corsia as well.
Right.
It's collision.
Sure. Well, I think Corsia is key to all of this, really, because it's at the intersection between the two. I think, in theory, I would say that, the Article 6 market should become bigger than the voluntary market over time, because even voluntary, so there's going to be a market for Article 6 credits right? And the biggest market initially is going to be Corsia, because they have to have Article 6 with corresponding adjustments, right? So that's the initial driver, really, in terms of a dedicated source of demand. That's where it's coming from. And those numbers, obviously, they change a lot according to analyst estimates, and the whole COVID thing completely changed the baseline for. But I think you're still looking at potential Corsia demand for Article 6 credits with corresponding adjustments of up to, let's say, between 1.5 billion and 2 billion tons between now and 2040. Okay. That's very substantial, right? I mean, that's a very, very substantial. If on top of that, you then say, well, perhaps the European Union will end up allowing Article 6 credits into the ETS 1, perhaps other jurisdictions might allow that. And perhaps also anybody who's buying voluntary credits today will start to say to themselves, we need a UN badge on the credits that we're buying. It's not good enough anymore just to have a voluntary credit. It needs to have the seal of approval of the United Nations, because that's the gold standard effectively now for the global carbon market. So I think for all those reasons, I think on a 5-year view, I would say the Article 6 market will probably be bigger than the voluntary market, maybe before that. But a lot will depend on coming back to what we said earlier, what the EU decides to do in terms of keeping the clock stopped or letting the clock start running again, which would effectively make Corsia much less compelling. As I said, that's not my base case. So I think Corsia will remain in place, and I think there will be substantial demand, and therefore it becomes a market, a really meaningful market. And I think, that will help encourage other players. One thing we haven't mentioned on this podcast, perhaps something for the next time, is China and China's carbon market, and how they are going to become a huge player in global carbon markets. And Article 6 could be a very good way for them to
extend the diplomacy.
Yeah, exactly. So lots to think about there, but speculatively, yes, I would say I'm relatively confident that the Article 6 market will overtake the voluntary market within 5 years.
Yeah, Renee.
I agree. I think it comes down to the drivers, right? And the Achilles heel of the voluntary market has always been, how sticky is that demand signal?
Yeah, exactly.
I do think it's a little bit of semantics insofar as, just because there's so much fungibility. And so I just think the voluntary market, firstly, my soundbite, my view here is the voluntary market isn't disappearing. It's effectively being absorbed, right? So Article 6 is turning what used to be good intentions essentially into formal obligations. And then you have this fungibility into compliance systems that are from sister agency, in the case of ICAO, which is a sister agency to the UNFCCC, now imposing on a sectoral basis here for international aviation, and that fungibility of instruments there. Ultimately, the architecture or the infrastructure that's been built over the last 25 20 or so years, let's just say, right, since the launch really of EU ETS, kind of starting the clock there, or the first firing gun, and the CDM, is that there's been so much learned, right, and so much experience built in and around project development. MRV, so monitoring, reporting, verification, the certification outcomes, and now the issues around leakage, right? CBAM being one, corresponding adjustments being perhaps the most eloquent yet most complex version of it, but effectively it leads to this kind of transition. And there's been so much written, so much said around integrity over the last couple of years. So I think if 2023 was the kind of the year about integrity, 2025 and beyond is about sovereignty. And now host countries really want their slice of the pie, and CAs really are how they claim it, right? And so I think that we'll start to see more harmonization between blocks, between countries and host countries, essentially looking at carbon as a natural resource that they can then utilize to exploit to generate revenue for their countries. But also, counteractive to that is their NDCs. And so, overly selling at the beginning may not be the most astute. And so you start to see that demand push and pull emerge. And I think the final thing that I'll say is you start to see broader participation. In a pure voluntary context, you have very well-intentioned, good intentioned kind of corporates doing it for CSR. That was the key driver. That's what kind of kicked it. And then we started to see more demand signals, more, and alignment between the boardroom and kind of civil society in 2020 kind of drive it. That was effectively broken with a distrust or an aversion to risk and reputational risk, in particular by corporates.
Yeah.
That's not the case when it's a compliance market. That's not the case when you have participation of those same corporates under a compliance system, or airlines under a compliance system. And more importantly, it's not just as corporates. And you talked about EU ETS 2 and kind of retail, but now you actually have G2G. You have governments playing in the mix. So there is appetite on the buy side across governments, corporates, and other systems where this is impacted. And I think that it really is it helps to underwrite what you've been saying around this very bullish case about carbon over the next 5 and then 10 and 15 and 20, 25 years ahead, where we start to see this convergence and market price signals. You see not a lot of noise, and it'll be the folks that make a lot of money out of this are the ones that can separate the noise to signal ratios. Exactly. So that's kind of my musings on the topic. What are your thoughts?
Well, I wouldn't disagree with any of that, Renee. I mean, I think this tension between, the fundamental distinction, as you articulated it there, between compliance markets where you have no choice, you have to buy, and voluntary markets. I mean, the clue is in the name, right? And, we've seen some of the large oil and gas companies row back from the ambitious carbon offsetting plans they had previously, Shell, BP, so forth. So that's part of the broader political issue, right?
Yeah, that's part of the broader political issue. Yeah, and those musings at the board level, listen, I won't signal out, but we've spoken to a number of large energy companies, and it's kind of it's dependent on the performance of their share price, right?
Well,
and the leadership at the C-suite, but they acknowledge, the ones that remain acknowledge that this is still a very viable market, and that they actually play a really significant role, and they have expertise with regards to origination. Building up those teams internally is really laborious and costly, and so maybe they're not the highest performing teams right now, but long term they don't want to abandon that. And other folks that are kind of moving away, I think, and we see this around commodity traders, but also energy companies that have they came in, they lost some key talent, and now kind of find themselves rudderless. I think that they'll come in 28, 29 with big M&A splashes to try to bolster their expertise as the market kind of starts to grow. But that's just kind of an internal view in politics and kind of M&A. But kind of to the point around what you were just saying is like, and to Eddie's earlier question, is Corsia and Article 6 are essentially injecting real and predictable demand. You looked out, a table effectively around the Corsia demand, in CP1, the phase 1, and now around a compliance phase that we're going to enter in 2027. And it's essentially, it's no longer just virtue signaling, and that's the fundamental difference between VCM and compliance. And that's going to shift the power effectively from the buyers to suppliers. So back a reversion back to a seller's market, where today it is purely a buyer's market in the carbon space, certainly on VCM. Buyers, in particular corporates, take their sweet time doing very extensive due diligence, being very risk averse from a reputational perspective. That's the story of the day. They have very laborious RFP processes, really onerous holds being placed on from the sellers, 90-day payment dates, et cetera. And that's just the luxury of what they can do today. But as that market inverts back to a seller's market, that luxury goes away really, really quickly. And I've seen that occur, in 2020 and 21 in particular. And as you start to see the emergence of futures contracts and greater liquidity emerge and more kind of participation from institutional and speculative traders, they mop up that slack really quickly, and it whipsaws back. And I think that's that's where we see it. And then when we talk, just anecdotally, I won't single out clients, but when we talk to folks, there's this very keen interest on Corsia eligible EUs, Article 6, 6.2 ITMOs and 6.4 ERs, and essentially wanting to get ahead of that. Effectively, it's a very long bias on carbon in the 2030s, certainly mid 2030s, very long bias. And the focus there is, how can I firm up that supply on a risk adjusted basis? How can I face a credible counterparty and de-risk the risks that are associated with project development, counterparty risks, delivery risk, certification risk, timing risk, political risk, et cetera, et cetera. And the answer's been, really, working with experts, understanding the kind of the nuances of the market, and then insurance, quite frankly, right? And then now emergence of more sophisticated developers that can actually, bring that experience, but help to underwrite and mitigate those issues, as opposed to kind of the boutique operators. And that's if we're going to do it at scale. So basically, I think the market's growing up, and it's an interesting time to be in the space.
I think that's
certainly. I mean, there's conviction that this market will be short, right, in the 2030s. That's our thesis.
Absolutely.
And I mean, there is inherent risk that companies, both in compliance and voluntary corporates, have to pay attention to, because it may be costs in the near term, but the costs are much greater in the long term at the end of the day from the transition. But look, I think that's a great way to wrap things up. Mark, been a fantastic deep dive, and thank you so much for sharing.
Please come back, Mark.
Yeah, absolutely.
Please come back. You're welcome back anytime.
Thank you very much.
Before we started recording that you're heading across to Mexico, but maybe when you're back, give us an overview in terms of what you're seeing on the ground there. And
definitely will do.
And let's muse on other things that are close and near and dear to your heart, especially ahead of where you end up in the next challenge.
Fantastic. Well, thanks, guys. It's been a pleasure as always. And when do you expect to put this out?
Next week.
Oh, right. Okay. Fantastic.
Monday.
Great. Yeah. All right. Well, I'll be tuning in from Mexico then.
Yeah, terrific.
All right.
All right. Take care, guys. See you soon.
Thank you. See ya. And thanks for tuning in to This Week in Carbon. Be sure to follow the show.
Oh, shit. I forgot to ask him about or get him to do a Hamlet or a Shakespeare quote.
I think he kind of
that was so good when he did it. He can't. He's an amazing guest, and I'm so glad that we had him on.
He is.